Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A market schism erupts as Oracle's AI reality check triggers a tech bloodbath while the Dow soars to record highs. Is this the Great Rotation's decisive battle? Second, Fed's hawkish cut masks a secret. A $40 billion stealth QE injection just ignited the markets. While stocks celebrate, why did one AI giant suffer a massacre? This is the critical signal all investors are watching. Finally, Disney's $1 billion AI bombshell, iconic characters licensed to OpenAI, triggering war with Hollywood unions. This historic deal redraws the battle lines, but could it spark a global digital sovereignty crisis? Red alert, folks. Oracle's massive earnings miss and shocking $12 billion capex surge have sent shockwaves through the market, sparking a major AI reality check. The Nasdaq is reeling down 0.7%, while the Dow Jones hits new record highs, up 0.87%. This is a critical inflection point act now to reposition your portfolios. Why does this matter? Listen to me. Oracle's unexpected $50 billion annual capex guidance and negative free cash flow have ignited fears that the AI infrastructure spending spree may not yield the expected profits. This has led to a sharp revaluation of tech stocks, especially those heavily tied to AI narratives. The ripple effect is clear. Nvidia opened down 3%, Microsoft and Amazon saw pre-market declines, and the Nasdaq is taking a hit. We're witnessing a decisive sector rotation from high-flying tech into fundamentally strong value stocks as investors reassess their bets on AI's profitability timeline. Let's break it down. The policy landscape isn't providing much relief either. The Federal Reserve's recent 25 basis point rate cut to 3.50% to 3.75% was expected, but Chair Powell's hawkish tone on future cuts has markets on edge. The Fed's message is clear. Inflation remains above target and further rate cuts may be limited. This keeps pressure on tech valuations as higher rates dent future earnings growth prospects. Now, let's talk money flows. Capital is moving fast. Institutional investors are pulling money out of tech-heavy ETFs, and the VIX has ticked up, signaling growing market anxiety. With the Nasdaq futures dropping, it's clear that the risk appetite is shifting away from speculative growth plays. In terms of valuations, this rotation is creating a stark divergence. Tech stocks with stretched PE ratios are facing compression. Meanwhile, the Dow's record highs are a testament to the strength of value plays as sectors like industrials and financials gain traction. The Russell 2000, with its domestic focus, is also hitting record highs, reflecting a broader appetite for value. Here's your game plan. Cut back on tech exposure immediately and shift into value sectors. Trim positions in Nvidia, Microsoft, and Meta by 5 to 8%. And rotate into financials like JP Morgan and industrials like Eaton. Time's running out to get ahead of this rotation. Do it today. Now, let's dive into sectors. Tech is in retreat. The semiconductor index, SOX, fell with Nvidia, AMD, and Broadcom all down. But the financial sector is thriving, buoyed by stable interest rates that enhance net interest margins. The XLF ETF jumped nearly 3%, with banks like Goldman Sachs leading the charge. For contrarian plays, watch Tesla. Despite broader EV demand concerns post-tax credit expiration, Tesla's market share is up. However, with shares down 0.5% pre-market, there's caution. Consider hedging against further downside. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. 1. Short term, 1 to 2 weeks. If NASDAQ 100 breaks below 25,200, act. Immediately reduce tech weight by 10 to 15% and increase financials by 3 to 5%. Use SQQQ for tactical hedging. Stop loss if QQQ rallies above 450. 2. Medium term, 1 to 3 months. Assuming Oracle's capex concerns persist, overweight industrials, XLI by 2 to 3%, targeting $42. Hedge using QQQ puts at 95% of current price. Reverse if Oracle's free cash flow turns positive. 3. Defensive, risk watch. If initial jobless claims rise above 250,000, increase cash holdings to 15% and reduce growth stocks by 5%. Monitor yields. If 10-year Treasury exceeds 4.5%, further reduce tech exposure. 4. Hedge options. Advanced investors use QQQ, put spreads for downside protection. Intermediate, adds QQQ as a hedge. Basic, maintain higher cash levels. Time's ticking. Let's dive deep into today's critical market dynamics. The Federal Reserve just announced it's buying $40 billion in Treasury bills, a stealth move to ease market conditions that sent stocks soaring. A while back, we flagged the growing split inside the Fed. This surprise liquidity move lands right on top of that debate and changes the near-term market calculus. This is where the situation takes a more complex turn. The Fed is calling this a technical move to manage liquidity, not a change in monetary policy. So the thing is, this comes right after the Fed ended its quantitative tightening program, which had shrunk its massive balance sheet from $9 trillion down to $6.6 trillion. Analysts thought they would wait until 2026 to start buying assets again. By starting now, the Fed is essentially injecting cash into the system to prevent any year-end market stress. To investors, this looks a lot like stealth QE or quantitative easing, which is why the market reacted so positively. After all, balance sheet actions can speak louder than policy guidance when liquidity is tight. This happened on the same day the Fed delivered a so-called hawkish quarter-point rate cut. The decision itself was a battle, with two regional bank presidents wanting to hold rates steady. We previously analysed this three-way split regional presidents like Austin Goolsbee and Jeffrey Schmid, arguing to hold, while Governor Stephen Miran pushed for a larger half-point cut, and today's outcome fits that pattern of open dissent. Interestingly enough, this kind of open disagreement is becoming more common. Historically, dissents at the Fed were rare, but this year we've seen multiple meetings with split votes. A fracturing consensus inside the Federal Reserve reduces the predictability of its future policies, and that can lead to bigger, more sudden market reactions. As we've said, a hardened hawkish block raises the bar for future easing and keeps rate volatility elevated. The Fed's own forecast then showed just one more cut penciled in for all of 2026. That lines up with the high bar we warned about a while back and the risk of a tougher 2026 backdrop if the rotation turns more hawkish. The reason for the Dow Jones Industrial Average popping over 1%, it boils down to that $40 billion surprise. The Treasury purchases effectively increased the money supply, a powerful signal that overshadowed the cautious rate cut. In other words, the internal debate may be tightening the path of rate cuts, but the balance sheet just did the easing. What's really happening is that these purchases help stabilize the crucial short-term lending markets where banks lend to each other overnight. By ensuring there's plenty of cash or liquidity, the Fed prevents borrowing costs from spiking unexpectedly. This extra liquidity gives banks and investors more confidence, encouraging them to buy riskier assets like stocks. It's a neat workaround we've cautioned could emerge if the committee stayed split, less policy rate generosity, more plumbing support. Then, Fed Chair Jerome Powell took the floor and completely dismissed speculation about future hikes, stating directly, "I don't think that a rate hike is anybody's base case at this point." Powell declared, "We have an extraordinary economy," as officials significantly raised their forecast for economic expansion in 2026. That tone runs counter to Moran's earlier argument that policy sits well above neutral, and it helps explain why markets focus on the liquidity boost rather than the slower path of cuts. However, the celebration wasn't universal. While the broader market celebrated, tech giant Oracle got hammered. The company's shares tumbled more than 11% in extended trading after it missed revenue expectations, dragging other AI-related stocks down with it. This really underscores the market's new show me the money attitude towards AI. At the heart of this is a metric called remaining performance obligations, or RPO. Think of it as the total value of contracts a company has signed but hasn't delivered or billed for yet. For Oracle, their RPO skyrocketed by an incredible 433% to over $523 billion thanks to huge AI deals. That's the hype. But their actual revenue for the quarter missed expectations. What's so striking here is that investors are no longer just buying the promise of future AI growth. They are now demanding to see that promise turn into actual sales and profits today. This puts a lot of pressure on the entire AI sector. This split reaction sets a stage for a dramatic end to the year. One senior economist at Interactive Brokers now says the Fed has essentially paved a way for a Santa Claus rally. The resulting call is that the S&P 500 is now poised to exceed the 7,000 milestone in the next few weeks. We said a while back that internal resistance would stress test dovish hopes. This liquidity backstop is the counterweight that could still carry markets into year end. So we're left with two competing narratives. The Fed's liquidity injection is a powerful tailwind for the stock market, potentially boosting everything from stocks to bonds. Yet, the punishment of Oracle signals a stark reality check for the high-flying tech sector. If the hawkish bloc holds the line, it may take a clear labour market softening to unlock more cuts. In the meantime, the stealth easing puts a floor under risk appetite. The ongoing focal point will be whether other AI-heavy companies can convert their massive backlogs, their RPOs, into actual revenue in the upcoming earnings season. The market is caught between the Fed's support and the demand for real profits. Speaking of the market demanding real profits from AI, promises that hasn't stopped one of the biggest names in entertainment from making a massive forward-looking bet on the technology. Get this, Disney just forged a $1 billion alliance with OpenAI. This is the first time a major studio has licensed its most valuable assets to a generative AI giant. A while back, we analysed Warner Music's bet on an exclusive AI partnership and warned that higher walled gardens were coming. This is that same playbook at full studio scale. Now, get this isn't just about licensing. It's a new phase in the AI arms race. What's really at stake is that large-scale content for equity deals, like this one, signal that access to proprietary data is now becoming as critical as computing power. Continuing our last discussion on the AI CapEx supercycle, a deal like this will intensify demand for specialized data infrastructure, exactly the kind of pressure we noted when even small supply imbalances drove unprecedented cost spikes. This move could accelerate massive investment in specialized data infrastructure, driving a new wave of growth for cloud providers and semiconductor firms, while increasing the competitive moat for AI leaders like OpenAI. Starting in 2026, users of ChatGPT and Sora will be able to generate images and videos featuring over 200 of Disney's most iconic characters. We're talking about properties from Pixar, Marvel, and Star Wars. Characters like Luke Skywalker, Deadpool, and even Mickey Mouse are on the table. But this isn't a simple partnership. It's a bombshell dropped in the middle of a Hollywood on high alert over AI. The entertainment trade union Equity immediately fired back with its head of TV and film, Kathy Sweet, stating this deal reinforces exactly why our members are fighting for AI protections. She called the sale of creatives' professional work an eye-watering big money deal where rights must be protected. We previously analysed how news publishers were using lawsuits to force value recognition from AI, creating what some called a data sourcing risk premium. Unions are voicing a parallel concern on the performer side of the ledger. To understand the union's perspective, you have to look at how this type of deal could create what experts call a bifurcated labour market. On one side, IP holders like Disney profit from these massive licensing deals. On the other, the rights of individual performers over their own digital likenesses become a huge battleground. As we discussed in music, IP owners race to partner while individual artists fight for control. The fear is that this could lead to more frequent and disruptive labour disputes, which could halt content production. But that's not the whole picture. The situation is even more layered because the deal was announced just as reports surfaced that Disney lawyers sent Google a cease and desist letter accusing the tech firm of infringing its copyrights on a massive scale. Recall, we also covered a wave of publisher actions against AI firms. Another signal that the legal front and the licensing front are advancing in parallel. So while Disney's CEO Bob Iger frames the OpenAI collaboration as a way to thoughtfully and responsibly extend the reach of our storytelling, the company is simultaneously taking legal action against another tech giant. The essence of this is a strategic pivot happening across legacy media, often called litigate versus license. Instead of just suing everyone, companies are now realizing they can proactively license their content libraries to AI developers. We previously described publishers' strategy as an AI put option, using litigation to set content as a paid input. Disney is now setting a pricing benchmark through licensing, potentially unlocking significant value for media stocks by creating a new valuation floor for their content libraries. One crucial detail, the OpenAI agreement explicitly does not include any talent likenesses or voices, signaling a line Disney isn't willing to cross just yet. And that detail is crucial because it reinforces the union's core fear. The agreement sets a precedent, the IP is for sale, but the human performer is not for now. This is exactly the bifurcated market we just talked about, where the value of the character IP is monetized, while the performer's rights remain a separate, contentious negotiation. And as we saw with music and news, once exclusivity walls go up, the bargaining dynamics get tougher. This billion-dollar pact isn't just a business move, it's a defining moment. By licensing its crown jewels, Disney has officially picked a side in the war for content, setting a massive precedent and redrawing the battle lines between old media and new technology. It also deepens the exclusive data ecosystems we've been tracking, those higher walled gardens around proprietary catalogs. The global proliferation of American cultural IP through AI platforms could now trigger a digital sovereignty response from other nations. Countries like China and nations in the EU may see this as a threat and accelerate investment in their own sovereign AI models. We previously focused on China's more top-down, state-aligned approach and how export controls are already pushing some training to overseas data centers. This could lead to stricter regulations on foreign AI-generated content and spur a push for self-reliance in foundational AI models. The big question now becomes whether this will fragment the global AI landscape, creating distinct digital ecosystems and new regulatory hurdles for multinational companies.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.